Alrighty, everybody. It is 7 o'clock, so I am going to go ahead and get going with our webinar tonight. For those of you that don't know me, my name is Alex Greer. I'm an Associate Wealth Advisor with Pathfinder in our Cary office. Really looking forward to running through the presentation tonight. We're going to be talking about planning for the next generation and really understanding Trump accounts. We have gotten a number of questions about these since they were announced and kind of established last summer. And so going to run through them tonight in pretty great detail, and then also run through some examples of just planning for the next generation. Before we dive in, again, thank you all for being here tonight. I just want to have a quick note here. For compliance purposes, we are unable to respond through the webinar chat or the Q&A features during the presentation. So if you do send a message or you send a question in that feature, I will not be able to answer it directly. We will have a dedicated Q&A session at the end of the webinar. And so if I'm going through and you have questions about anything that comes up or you think of something, please submit your questions to pwcmarketing@pathfinderwc.com. Again, that's pwcmarketing@pathfinderwc.com. If you send the question over to that email, I do have access to it. I will take a look and be sure to answer it during the Q&A session. I will also have my contact information at the end of the presentation. You can always reach out that way as well if you have a question that comes up after we get off the call tonight. So before we dive in, just a quick agenda. I am going to spend the bulk of the presentation talking specifically about Trump accounts, what they are, what we know, really diving into the specifics of them. But rather than just talk about Trump accounts, I do want to talk, quickly about some other child savings options that we have, and then really run through a few case studies and kind of talk through how we plan for children, how we plan for the next generation, and how we incorporate that into a comprehensive plan. I think anytime we're talking about specific account types, it's really, really important to also think about how would we actually utilize these, or how would they be incorporated in a real life situation. So let's go ahead and dive right in and start talking about Section 530A accounts. So Trump accounts, the technical name for them, or what they technically are, is a 530A account. Everyone that I have spoken to, though, knows them as Trump accounts. And so really what these are a new retirement savings vehicle for children that are under age 18. So this is a completely new way to save for children, and it is a way to save for retirement for people that are under age 18. The big thing, or the big change in these, is that there is no earned income requirement to contribute to these accounts. So minor IRAs or custodial IRAs have been around for a long time, but for someone under 18 to contribute to an IRA or a Roth IRA, they have to have earned income, just like an adult has to have earned income to contribute to those account types. And so, you may see that with a high schooler. A 16 or a 17-year-old may have earned income and be able to contribute to those IRA accounts. But, pretty difficult for a 5-year-old to have a steady income, have a steady job, and be able to save for retirement. So with these Trump accounts, there is no income requirement on the kid to be able to contribute. Also, these are designed for retirement. And so with that, there are some tax advantages. Contributions to the account grow tax deferred. So what that means is that when money is put into these accounts, as the accounts grow in value over time, there's no tax on the interest or the dividends that are paid out in the account. It's completely tax deferred. Now, there is a note there on the screen. Contributions grow tax deferred. They are not tax deductible in the year that the contribution is made. And so what that means is that, unlike contributing to a traditional IRA or maybe a traditional 401k, when someone makes a contribution to these accounts, there's no tax reduction or deduction in that year that the contribution is made. There are income taxes on the distributions in the future. We'll get into that in more detail in a few minutes. And just some key dates here for these account types. Like I mentioned, they were actually written into law last summer on July 4th with the passing of the One Big Beautiful Bill Act. So January 1st of this year is when people started to be able to actually open these accounts. So right now, accounts can be opened. No funding has happened yet, though. So the contribution window actually is set to begin on or just after July 4th in a couple of weeks. So a few weeks from now is when we will actually start to see contributions being made to these accounts. And so as we talk about contributions, I want to talk about the contribution rules because they are a retirement account. And so with that comes some contribution rules and contribution limits. And so the first thing to note is that there is an annual contribution limit of $5,000. This is indexed for inflation, so that number is going to go up over time. But right now, no more than $5,000 can be put into these accounts for the benefit of a child. One thing to note, that does not count towards the IRA contribution limit. So a quick example of that would be, let's just say there was a child that was 16 years old, and that child worked a summer job and made $1,000. That child would be eligible to have $5,000 contributed to a Trump account. That child could then also contribute up to $1,000, the amount that they earned, into a custodial IRA or custodial Roth IRA. So those two contribution limits are separate from each other. And the contributions don't have to be made by the child. So family and friends are eligible to contribute up to that $5,000 per year limit. Now, again, as a reminder, that's not tax deductible for the family member or friend that makes the contribution. So there's no tax benefit to the person actually making the contribution. And that $5,000 limit is the total limit. So let's just say a parent contributes $2,500 and then a grandparent also contributes $2,500. That is all the contributions that can be made for the year. The parent and grandparent cannot both make $5,000 per year contributions. Employers are also allowed to contribute. Employers can contribute up to $2,500 per year. So that's a benefit that employers can offer towards employees. The employer portion does also count towards that $5,000 limit. That contribution is excluded from employee income, though. So that's another way that contributions can be made to these accounts. Government institutions and nonprofits can also make contributions. There was a note in the legislation, there was no stated limit, which didn't count towards the $5,000 aggregate limit. That's an area that we are still awaiting clarification on. But really for me, as I think about this and as I've talked about this with clients, the big thing to note is the $5,000 annual contribution limit, which will go up over time. Now, in addition to this annual contribution limit, it's really, really important to talk about the pilot program credit. You may have heard about this in the news. It's been covered pretty extensively. Children born between 2025 and 2028 are eligible to have a $1,000 government credit used to fund the account. Children born before 2025 can still open a Trump account. They just are not eligible for this pilot program credit. And so what we know about this credit and how it's going to actually operate, parents have to opt in to receive the credit and to open a Trump account. So every newborn born between 2025 and 2028 is not going to automatically have a Trump account with the pilot program credit placed into it. It is important that the parent make sure to open the account and opt in. To actually do that, to open the account and opt in, the easiest way is actually to go to trumpaccounts.gov. They've set up a website. You can go through a process there to establish an account. And once you put in the date of birth for the child, right now we're in the middle of 2026. So if the child was born in 2025 or so far year to date, that child will be eligible for the pilot program credit and you can opt in at that point. One thing to note is that the child does have to have a valid social security number to have the account opened. So if you have a newborn, you may have to wait until they actually have that social security number to open the account. Outside of going through trumpaccounts.gov, you can file Form 4547 with your taxes to get the account opened up. With clients that I have spoken to, though, it's probably going to be easiest to go through the online website to get it established. That essentially files the paperwork to get everything taken care of without you having to add in an additional form to your tax return. And so the one thing down here at the bottom, what you can see, as I said, anybody can contribute to the account. But as far as who can actually open the accounts, legal guardians, parents, adult siblings, or grandparents can open the accounts on behalf of the child. And this is a really important note. That order there is really, really important because that is the order of preference for who can open the account. So a big planning note with Trump accounts is that a child can only have one Trump account. So it's different from, say, a 529 account, a college saving account in that way. A child can have multiple 529 accounts. I've got clients where the parents have a 529 account open for the kids, and then the grandparents have a separate 529 open that they're funding as well. With Trump accounts, there's only one account allowed per social security number. And so with that, the order that you see here below is technically the order of priority for opening the account. And so I say all this to say, if you're a grandparent and you're sitting on this webinar, you're thinking about it, you'd like to consider doing this, I think it'd be very, very beneficial to talk with the parents first, make sure that they haven't already opened it. And even if they haven't, it's probably going to be easiest if they go ahead and open it and they are the ones to actually open the account versus the grandparent trying to open it. If you don't communicate well, what will actually happen is that once the account is open on behalf of the child, if someone else tries to establish an account using the same social security number, they're not going to be able to open up that account and get it funded. Again, it's all tied to the social security number, and only one is allowed per beneficiary. So that is a little bit around the actual opening and funding. And again, the pilot program credit, really, really important to keep in mind for children born last year, this year, or over the next 2 years, as that is a $1,000 government credit that will be used to fund the account. And one other note, that's in addition to the $5,000 contribution limit. So let's just say that there was a child born in 2026, an account could be opened, the parent could opt into the $1,000 government credit, and then the parent could contribute $5,000 on top of that $1,000 government credit. So let's talk a little bit about the actual investment side of the Trump accounts. Like I said, these accounts are designed to be retirement savings. They're designed for long-term investing. There are restrictions though. So it must be US equity index funds held within the account. Think mutual funds or ETFs. You're not going to be able to purchase individual stocks. So you're not going to be buying Amazon or Microsoft or Nvidia, any of those individual companies within the account. These are going to be market cap weighted indexes, and we're not going to have sector specific indexes either in the accounts. There's also no leverage allowed. So you're not going to be trading on margin or trading options within these accounts. Again, this is designed to be simple, low cost, long-term investing. You do see the note down there at the bottom. The expense ratios on these funds are capped at 0.10%. So again, this is designed to be low cost, really, really long-term investing. This is not designed for someone to go in and place hundreds of trades throughout the year or to be day trading within the account. It's really designed to be as easy as possible and long-term thinking retirement investing. Now let's talk a little bit about the distribution rules from within these Trump accounts. We've talked about how you can contribute, how that money can be invested. What does it actually look like to take money out of one of these accounts? So the first key planning point is that no withdrawals are permitted before age 18. So when thinking about, does one of these accounts make sense for my kid or grandkid, the first thing to think about is, when does that money need to be accessed? These are designed for retirement, and you can't access the money at all before age 18. So if you want to use these funds to, help pay for trips that you take with the child, or even things like a private high school education, this is probably not the account type for you. Starting at age 18, withdrawals are taxed like an IRA. So there is the ability to pull from the account starting at age 18, but that is going to be taxed like an IRA. And there's also potential penalty depending on what that withdrawal is for. So there are some qualified distributions that would allow someone to pull money out of the account before they reach retirement age. These are things like higher education expenses, up to $10,000 for first-time home purchases, or business startup costs. So if money is pulled from the account to fund these different things, there's not going to be any early withdrawal penalty on that distribution. One thing to note, there's no early withdrawal penalty, but there would still be ordinary income taxes. So if money was pulled from the account at age 20 to pay for college, there's not going to be a penalty, but there are going to be income taxes due on the earnings on that distribution. And if money is pulled for non-qualified withdrawals before age 59 and a half, you're going to have income tax plus a 10% penalty. And so, if someone pulls the money out at age 22 to buy a car, not only are they going to be taxed, have income tax on that distribution, they're also going to have a 10% penalty. Now, after age 59 and a half, distributions are permitted for any purpose. There's just the income tax to consider. I will say, for a newborn, 59 and a half is a long way away. Gosh, that's almost 60 years. We would be out into the 2080s, I believe, which doesn't even sound like a real decade to me. So that's a key thing to think about here. The one other item to consider with distribution rules, and this is something that's come up in planning with some clients, is once the child reaches age 18, they are in control of the account and they are eligible to pull money from the account. So it is designed for long-term retirement savings. One of the concerns that I've had voiced to me is, well, what if we fund this account for 18 years and then at age 19, my child decides they want to buy a car with the money? Unfortunately, the child would have the ability to pull the money, and there's nothing the parent could do at that point to stop that distribution because the account would be in their name and they would have control over it. And if that was pulled out to buy a car, like I said, it would be subject to tax and a 10% penalty. So that's just a quick overview of the distribution rules and what that looks like. And that's really the entirety of the Trump account specific part of the presentation today. We talked about what they are, what they're designed to do, the contribution rules for them, the investment rules, and the distribution rules. And so before I hop into the case studies, I do want to talk about a few other child savings account options and just give you a quick highlight of how they work, because I think that's going to help explain some of the case studies that I run through. This is not an exhaustive list, but it is some of the very common types of accounts that we see. So the first one I want to highlight are 529 plans. I've referenced those a couple times in this presentation. 529 plans are designed for college savings. The big difference with 529 plans versus a Trump account is when money is put into a 529 plan, it grows tax deferred. If that money is then pulled out of the account to pay for college, not only is there no penalty, there's also no income tax on the money. So if our goal is to save for college specifically, or just for education related expenses, that could be things like a trade school or other certification programs, a 529 plan may make more sense. Another key difference with a 529 plan is that at age 18, the parent still is the owner, or the owner of the account stays the same. So the child does not gain control of the account at age 18. Outside of 529 plans, there's also minor Roth IRAs. And so I just wanted to mention these. I know I've talked about IRAs and Roth IRAs, but really the big difference here, obviously the child would have to have earned income to be eligible to contribute to these accounts. But if money goes in a Roth IRA, that money would grow tax deferred. It would also eventually come out of the account tax free. And so if the child has earned income and saving for retirement is a primary concern, minor Roth IRAs make a lot of sense and may ultimately be a better option than a Trump account. There are things called UGMA or UTMA accounts. These are more traditional investment accounts. It's a way to open up an investment account for a child that's in a child's name. These accounts, they work a lot like a regular taxable account. There's not any tax deferred growth or anything like that in the accounts, but it does allow a child to have money transferred and be invested for them. And at age 21 in North Carolina, they become the owners or the in control of these accounts. And then, outside of this, one thing that I always like to mention is another very valid and frankly efficient way to save for children is just to have parental savings that's eventually transferred via gifts. So you can save specifically for a child in your own investment account and just know that one day down the road, you're going to gift that money to the child. Just to give you an idea, right now in 2026, you can gift up to $19,000 a year completely tax-free. There's no reporting requirement on that either. And even if you gift more than that, it just requires filing a tax form to use up a part of your lifetime exemption. I'm not going to get into the details of all of that tonight. I don't want to keep everybody for too long, but parental savings transferred via gifts can be a great way to build assets and transfer them to the next generation while also retaining your own flexibility and really retaining control of the assets. And so now that we've talked through Trump accounts and we've also talked through a few of these other child savings account options, I want to run through just a few quick hypothetical case studies with you. I think case studies are the best way to actually illustrate how we think of all of this in an actual planning scenario, instead of just talking about the different account types and the rules that are associated with them. So we're going to start here with Tim and Meredith. They're 34 years old and they are parents to Sam. She was born in 2025. They're located in Raleigh, North Carolina. And Tim and Meredith, at the start of their financial plan, they really want to retire when their daughter goes off to college. So if they're 34 right now, we're looking at a pretty early retirement. We're talking early 50s, probably somewhere around age 52. They also want to maximize savings for their daughter, but really their priority is making sure that they're able to retire when she goes off to school one day down the line. And so in thinking about that, it's really, really important for them to make sure that they have enough savings built up to accomplish their own financial goals. And then we can also model out what future gifting may look like for Sam. And so the way we would solve this is we'd help Tim and Meredith build out a personal financial strategy. we'd really create a financial plan centered around their retirement at age 52. Again, if that's their primary goal, that's what we need to put at the center of their financial plan. Because they want to retire at age 52, which is prior to them actually being able to access their own retirement accounts penalty free, we'd prioritize savings into a taxable brokerage account, which would allow them to pull from the account early in retirement without incurring any penalties on their retirement accounts. We would then also, in conjunction, develop a future gifting goal that they'll be able to execute with flexibility. So once Sam goes off to school, they can use that investment account to help pay higher education expenses. They can also use it to help fund major life events, whether that's starting a business, a down payment on a home, or even things like a wedding. They can pull from the brokerage account for that. Again, we're going to model that out in the plan for them. And now what we would advise them to do, though, because Sam was born in 2025, is we'd advise that they open up a Trump account for Sam to claim that $1,000 pilot credit. Just because a Trump account doesn't necessarily fit with their goals that they've outlined, it still makes sense for them to claim that credit and let that money grow for Sam's benefit. And then we could advise down the line on what to ultimately do with that Trump account. And in addition to this case study, I want to run through one more. I want to look at Dave and Jenny, age 44, parents to Baxter, who is 6 years old. They're located down in Wilmington, North Carolina. And Dave and Jenny want to ensure that they're setting up their son, Baxter, for success. They want to save for future education expenses, including potentially funding private, middle, and high school. So at the center of their financial plan, what they're really concerned about right now is getting Baxter's education funded and paid for. And so the way I would look at that or think about that is that we really need to prioritize that individual goal of saving for Baxter, especially around education. So the first thing we would probably do is ultimately determine that a 529 account makes is the best savings option. That's due to the tax-free distributions for education expenses and the distribution flexibility. If you remember what I mentioned earlier, not only is that distribution tax and penalty free for college, but there is also the ability to pull up to a certain amount each year to fund private, middle, and high school, or anything K through 12. We would establish a funding plan for the account, so we'd make sure that we are putting enough into the account to meet that specific goal. And really, we'd also put this goal in the context of Dave and Jenny's long-term plan to make sure everything fits together. It's not uncommon for us to have people come to us, and a big priority for them is to make sure that they are saving for their kids and they're setting their kids up. And while that's certainly a really, really important goal, and we want to work to accomplish that, it's also important to make sure that the parents or grandparents are saving enough for themselves and are able to fund their own retirement and make sure they have enough to cover their needs long term. So those are just a couple of case studies. I think maybe the big theme that you notice on those two case studies is that neither one of them specifically involved funding a Trump account for specific goals. And I just wanted to use this to illustrate the fact that Trump accounts, they're a new tool that's available to us, and it very well could make sense. But just because Trump accounts have been introduced, that doesn't mean that if you want to save for a kid, you automatically have to open a Trump account and use that to save. I think it's still really, really important to specifically define the goals that you want to save for. And then once you've done that, select the account type to accomplish those goals. I'll say personally, I've had clients ask me, are these accounts good or are they bad? And the answer is, I would say, they're not actually good or bad. They're just a new tool that's available to us. And so we want to make sure that we understand the rules around them and where appropriate, utilize them, but also make sure that we are still considering the other options that are available to us over time for the funding. And so that really is my presentation for tonight. I do want to open up to questions here, though, and run through. It looks like I did have a couple of questions come through either prior to the webinar or during the webinar. So I'll kind of run through those really quickly. Can the Trump account be started at any age for a child? And the answer there is yes, like I said in the presentation. Trump accounts can be opened for any child. A child is below age 18 on December 31st of that given year. So if you have a child that's turning 18 this year, they're not going to be able to have a Trump account opened. But if you've got anywhere from age 1 to age 17, a Trump account can be opened on their behalf. It looks like we had another one come through here, looking for best saving options for my kids. And so to that question, I think I'd really point back to the case studies that I ran through. I do think that it's really, really important to think about these specific goals that you're trying to accomplish and then marrying that account type to that. There's a lot of options out there when it comes to saving for kids. I covered the new Trump accounts, and then I would say 4 of the most popular methods to save. But there are a number of options outside of that that could be utilized to save for kids as well. So hopefully the content tonight gave a pretty good answer around that. But if you do have specific questions, I'd encourage you to reach out either to myself, or if you're working with a different advisor here at Pathfinder, to reach out to your advisor to really talk through those goals and what you want to accomplish. And then we can make sure that we have the right account type or the right savings plan recommended for you. Looks like, can a child have more than one Trump account? Again, mentioned that in the presentation, but no, only one Trump account per child is allowed. There cannot be multiple Trump accounts per Social Security number. Let me see here. Oh, this is actually a good one. This is looks like the last one we had come through. Can a Trump account be converted to a Roth IRA? That's a really, really good question. And the answer is that there is the possibility to do that. Now, it has to be done after age 18 for the child. The actual logistics of how this works, if a Trump account is opened for a child, and that account is, let's say it's open when they're born, it's funded for 18 years, and then at that point, they turn 18, they get control of it, it's actually going to turn into an IRA for them. And so once that account is a traditional IRA, which is what that will be, at that point, they would, under current law, have the ability to convert that account to a Roth IRA. And depending on that child's situation, it could make sense at age 18 and their income level to go ahead and convert that full account. The one big thing to note there is that in that year, if you converted the entire account, all of the earnings would be taxable as income to the child. So there would need to be a plan for how to pay that tax bill, but that certainly is a planning option under current legislation. That's a really, really good question, and it is something to consider when you think about opening a Trump account. Looks like those are the 4 questions that we had come through. I am going to do one last look here just to make sure we didn't have anything additional come in. It does not look like we did. And so that is the full list of what I've got for tonight. Again, thank you so much for joining. I hope you got a lot out of the presentation. I hope it answered some of the key questions that you have. I've got my contact information listed out here. So there's my email. It's just alex@pathfinderwc.com. And then I've got our Cary office phone number here as well. If you have specific follow-up questions after this, please feel free to reach out to me. And I know we've got some clients of other advisors on the call here as well. Please feel free to reach out to your advisor as well if you have specific questions. We are all well versed in these and just in planning for kids in general. So again, thank you all so much for joining the webinar tonight. I really appreciate your time, and I hope you all have a wonderful evening.